When Jerome Powell speaks, we listen. And today in Providence, the Fed Chair reminded everyone of this simple truth, which is that there is no risk-free path forward, whether it's cutting rates too fast and letting inflation run, or holding policy too tight and suffocating the job market. Whatever they do, they got to be careful, and Powell made that pretty clear. So we're living through one of the most complex balancing acts in modern economic history. So today out in Rhode Island, Powell largely echoed what we already knew, what we had heard after last week's rate cut. He repeated that the Fed is now leaning a little more towards protecting the labor market after years of inflation being their main focus. And he described the situation pretty bluntly, that near-term risks to inflation are tilted to the upside and risks to the employment market to the downside. And in translation, prices still aren't fully under control, but the job market is cooling so much that it's become this real threat that now they got to keep an eye on that. And yeah, it's true, job growth has slowed to a crawl this summer, and for the first time in years, the U.S. economy isn't even creating enough jobs to keep up with population growth, which that's why Powell framed this as a two-sided risk, because if they cut rates too aggressively, inflation creeps back above 3%, which is further away from their 2% target. And if they're too restricted for too long, the unemployment rate climbs faster than anybody wants, and that could get dangerous pretty quickly. So the Fed is fully aware that they must move, but they got to move cautiously. Now, naturally, markets wanted more clues about what's coming next, and especially at that October 28th through 29th meeting, we'll get the interest rate decision from the Fed on the 29th, which is where markets see a high chance of a 25 basis point cut, according to the CME Fed Watch tool. So they see a 0.25% cut, but there is this small chance of them pausing. But overall today, Powell didn't mark off the chance of a cut. He didn't bite. He didn't rule out another cut, but he didn't lean necessarily dovish either. Instead, he kept it pretty classic Powell, data dependent, cautious, deliberate. And he even noted that stock prices are fairly highly valued, which I thought was a weird way to put that. And he stressed it isn't time for financial instability just yet. And that subtle comment alone was enough to weigh on tech stocks today. We've seen stocks move lower after 3 straight days of gains. The S&P 500 dipped lower today. It was dragged lower by the Mag 7, the Magnificent 7. And remember, those 7 mega cap tech stock companies now make up roughly 40% of the S&P's value overall. So when they wobble, the entire market feels it. And you know that saying, a rising tide lifts all ships? Well, in the reverse end, it's the same thing. So when the tide goes down, all ships go lower as well. So we seen today the NASDAQ down almost about 1%, the S&P 500 down a bit over 0.5% today, and largely all of this was due to Powell's comments on what he didn't say, because a lot of people were hoping to hear, like I said, clues as to what to expect this year regarding rate cuts, and we just didn't get that. Now, more broadly, there's this dynamic where so much wealth creation depends on a handful of giant companies, and it sparks this interesting question. In an era where markets look overvalued, we question this all the time on this channel, what do you actually invest in? And I came across multiple articles today talking about that, and I thought it was fascinating how one of them broke it down recently. So to land in the Forbes 400 list by the age of 65, starting at age 25, you need to invest around $245 million, which that's not something you're just going to compound out over a $5,000 portfolio into the S&P 500. So what that means is building real wealth comes down to creating real value, whether that's launching some product, inventing something, building a service. And the world actually needs this kind of stuff. That's how we keep on moving forward. So Alex Hormozy calls this the SME 500 instead of investing into the S&P 500. And I'd agree, he's pretty right. The stock market is a powerful tool, but it's not this lottery ticket where you get rich overnight, which you don't get rich overnight really in anything unless you're just lucky. It's the amplifier for the wealth you create elsewhere. So I just wanted to throw that out, this piece in there, because we're talking about markets, the direction, the risks at play here every single day on this channel. And there's this question as to, man, if everything's so high and I don't necessarily want to take the risks of the downside for a little bit of upside, where should I put my money? Because then I'm losing money to inflation. So just think about that. But now, interestingly, not all Fed officials are on the same page as Jerome Powell. Governor Michelle Bowman spoke today in Asheville, North Carolina, and what she said, she sees last week's cut as just the beginning of cuts. She wanted to cut rates as far back as July. And the view she had is that the slowdown in jobs averaging just 25,000 a month since April makes it pretty clear the Fed needs to ease further. They need to do something. And Bowman pointed to AI investment and healthcare hiring as the main engines of growth right now. But she did admit that the broader picture does look a little bit patchy. So if it wasn't for both the healthcare and the investment, the AI investment right now, it wouldn't be looking too good, is kind of what she's hinting at. Now, meanwhile, we got the PMI data today, and that kind of backed that up. So U.S. business activity expanded in September, but at the slowest pace in over 3 months. Manufacturing, services, hiring, all of those showed softer momentum, and while tariffs are still raising input costs, companies are struggling to pass those costs on to consumers. And Powell kind of mentioned that because he said the main people that are absorbing the tariff costs are the retailers, and little bit of costs are being passed on to those consumers, which is ironically good news for inflation, but bad news for margins of these companies. And that kind of turns around to their stock. And if the stock's not doing good, the stock goes down. So you kind of pay for the tariffs regardless. But where does that leave us now? Markets wanted Powell to be more neutral dovish today, hinting at rate cuts to come. Instead, he played it pretty steady. And that disappointment is why tech sold off today. But the Fed's internal debate, we got Bowman pushing for a cutting cycle, Powell urging for caution. Yesterday, we seen Alberto Mussolini kind of in the middle. We seen Raphael Bostic. He didn't really support cuts. And Stephen Myron, that man wants more cuts. So others warning about inflation regarding the Fed. And all of these moving pieces will shape every move we go from regarding where we go, I guess. Now, tomorrow, all eyes will be on some of the data we'll get out tomorrow. Let me pull this up on the screen for us. And what we got tomorrow is new home sales at 10 a.m. A lot of people in the markets won't necessarily watch this, but I am a real estate agent. I like watching the real estate market. This is where a lot of wealth is tied into. This is where a lot of lending comes in. People get HELOCs, mortgages. A lot of wealth is tied up in a real estate. So I like watching this. Now, new home sales is a huge catalyst because it kind of tells you about expectations of what to expect. And new home sales, where's it at? Let's put it on here. So we're expecting, so the previous number was 652,000. We're expecting that to come down a little bit. And when we're expecting less new home sales, what does that say about the market? But we are looking at August. That's right around where school starts. So it is a slower time, but that'll be 10 a.m. Eastern time. And then later on tomorrow at 4 p.m. Eastern time, 4:10. Why couldn't they make it 4:20? We'll get San Francisco Fed President Mary Daly's speech. And these may seem like small events compared to Powell today, which, I mean, that was a nothing burger, but they'll help at setting the tone as investors try to parse whether more cuts are coming soon and kind of where everybody's head's at and what's the data saying. So the big takeaway here, everybody, to take away from today is that the Fed knows the risks are two-sided and there's no easy escape route. Investors, meanwhile, are still wrestling with whether markets are climbing a wall of worry or teetering on the top of it. So just like that, Powell said there's no risk-free path. And man, that shines so true. No matter what, there's some type of risk we got to consider. So all we could really do, y'all, is come back tomorrow, hang out with me. learn, and coffee up. I'll see y'all tomorrow.